Okay, so inflation's got you thinking, huh, yeah, I get it. It's been the talk of, well, everywhere lately. And it's got everyone wondering, does that age-old advice, run to the stock market, still hold water?
It's a fair question, for sure.
So to really dig into this, we're going back to the source, Cracking Open the Intelligent Investor by Benjamin Graham.
Ah, Graham, always a good place to start.
Chapter 2, to be exact, to see what a century of market data, booms and busts, can tell us about inflation and what it means for our money.
Smart move, going right to the source. Graham kicks off his analysis in 1915, giving us a long view perspective that's, well, let's just say it'll make today's headlines seem almost boring.
Right, like everyone's freaking out NW. But was this kind of thing happening back then, too? What was the inflation situation like from, say, 1915 to 1970?
In a word, significant. We're talking periods where the cost of living in the U.S. it practically doubled, sometimes in just a few years. Jumps way bigger than anything we've seen recently. See, that's what I think we forget so easily. It's like, this feels huge right now, but zoom out a little. So if inflation's not this new beast, did stocks actually outrun it like, we're always told?
That is the million-dollar question, isn't it? And, it seems like a simple answer on the surface, right? Inflation eats away at cash, stocks are supposed to grow. But Graham's analysis, it shows us it's not quite so cut and dry anymore.
I bet a lot of people listening are nodding their heads right now like, yeah, tell me more. So what changed?
Well, two big things, really. First, while it's true that stocks, they did outperform bonds over that 55-year period Graham looked at, the returns you can get on high-grade bonds these days, they're actually pretty darn close to that historical stock performance.
Hold on, so you're saying just parking my money in a safe and boring bond today, that might get me similar returns to taking on all that extra risk with stocks? That feels wrong somehow. I know, it's counterintuitive. But that's because the whole investing landscape has shifted. See, Graham, he uses the Dow Jones Industrial Average, the DJIA, as his benchmark. Back in 1915, it averaged around, 77. By 1970, it was up to about 753.
Okay, so rough math here. That's like, what, almost a 10 times increase over 55 years? Not too shabby.
Exactly. You're looking at about 8% annualized return on that, including dividends. Seems fantastic, until you realize some bonds today, they're offering yields in that same ballpark. So that old chestnut, stocks always beat inflation, needs an update, my friend. It's not so simple.
All right, so that's aha moment number one for me. But now I'm thinking, okay, but don't they make more money when prices go up? So wouldn't their stocks still do well during inflation? It seems logical, at least in my head.
It's a perfectly reasonable assumption. I mean, rising prices, higher profits, that's the idea, right? But here's where Graham gets really insightful. He dug into the data, and what he found is fascinating. There's no clear direct connection there.
Wait, really? Now that is not what I expected.
Yeah, it's one of those things that feels like it should be true, but the real world, it's always more nuanced. He found zero consistent correlation between inflation and how fast companies' earnings were growing. In fact, there's a stat he highlights that's, well, kind of shocking, actually. Between 1950 and 1970, get this, wholesale prices in the U.S., they shot up almost 40%.
40%? Okay, that's a lot.
Right. So did corporate earnings follow suit? Did they skyrocket too? Nope. If anything, returns on invested capital, they actually dipped during that time.
So prices are going through the roof, but companies aren't necessarily cashing in. What's the deal with that? Got to be more to it.
You hit the nail on the head. That's where things get really interesting, and that's where we'll pick up after the break.
Okay, so to be clear, we left off with skyrocketing prices, but company profits not exactly keeping pace.
Yeah.
So where do we even go from there?
All right, well, Graham, he points to this massive increase in corporate debt during that same period. Like, it was huge.
Debt again, huh? Seems like it always comes back to that. But how does that play into, the inflation puzzle?
It's all about how companies finance themselves, really. See, when they borrow to grow, it can make their returns look better on paper, right? But they're essentially using borrowed money to try and make more money.
Okay, I'm following so far. But how does that tie specifically to inflation, though?
Well, picture this. A company's up to its eyeballs in debt, right? And suddenly, boom, inflation spikes. Now what happens? The cost of servicing that debt, just paying the interest, it skyrockets too.
Oof, yeah, that hurt.
It can wipe out profits faster than you can say inflation, even if their sales are going up because of, well, inflation. It's like running on that treadmill. You're moving, you're working hard, but you're not actually getting anywhere.
Love that analogy. Is there something specific in Graham's writing that really hammers this home?
There is, actually. He compares corporate earnings, what they're bringing in, to their total debt. In 1950, earnings were about 30% of debt. Seems almost reasonable, right?
Yeah, manageable, I'd say.
Right. By 1969, get this, that number plummets to 13.2%.
Whoa, that's a free fall. So debt really was exploding back then.
It was like a ticking time bomb. And that, combined with rising interest rates, which often go hand in hand with inflation, helps us see why those company profits didn't exactly boom like we might expect. It's not as simple as inflation equals more money for companies. Debt, those interest rates, how companies are actually financing their growth, it all plays a part.
Okay, so no easy answers here, which I guess is why we're doing a deep dive and not just, reading headlines. But knowing all this, what's an investor to do with this information? I mean, should we all just panic, sell everything, and hide under a rock?
It's a natural reaction, right? But Graham, he's actually quite reassuring on this point. Instead of panicking, he says, stick to your guns, diversify, especially when things feel uncertain. Don't put all your eggs in one basket.
Diversification. Classic advice, don't put all your eggs in one basket. But what about those alternative investments everyone's always talking about when inflation rears its head? Gold, real estate, that sort of thing. Aren't those supposed to be the answer?
You're right on the money with that thought. I mean, it makes sense, right? These assets, they're tangible. You can hold them in your hand, unlike, dollars that seem to be shrinking every day.
Yeah, it's that hold it in your hand feeling, like because you've got something real.
Exactly. But here's where Graham's take gets really interesting. He was actually pretty skeptical of those assets as inflation hedges, especially for us regular folks.
Really? That's surprising, honestly. I think he'd be all about gold, given his, cautious approach.
You'd think so, right? He actually uses gold as an example in the book. Between 1935, when, fun fact, Americans couldn't even legally own it, and the early 1970s, the price only went from $35 to about $48 an ounce.
Let me get this straight. So that's what, like a 35% gain over several decades?
Yeah.
Not exactly setting the world on fire, especially when you consider you're not earning any interest or dividends on that gold bar gathering dust in a vault somewhere.
Exactly. And let's not forget about storage costs, insurance, the works. Graham's argument is basically, you probably would have been better off stashing your cash in a plain old savings account during that time, even with inflation slowly nibbling away at your purchasing power.
Wow. Talk about a reality check. It really makes you question those so-called safe havens, doesn't it? But okay, what about other alternatives? Like, everyone's talking about collectibles these days. Is now the time to, I don't know, build that vintage baseball card collection or something?
Graham talks about those too. Diamonds, rare stamps, paintings. He acknowledges their potential, they could go up in value, but he also warns that those markets are often driven by pure speculation, risky business, especially if you don't know what you're doing.
So no get-rich-quick scheme with the vintage Beanie Babies then?
Afraid not. Remember, we're talking about investing here, not gambling on the next big fad.
Right, right. Okay, so collectibles are out. What about everyone's favorite, real estate? People always say that's a good hedge against inflation, right?
Graham tackles that one too. He gets it. He acknowledges that real estate can be a solid long-term investment. And yeah, it offers some protection against inflation. But, and this is a big but, there are downsides.
Okay, I'm listening. Hit me with those downsides.
First off, real estate values. They can be just as volatile as stocks, sometimes even more so. Location, 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 right? Timing, interest rates, it all factors in. And unlike stocks, which you can buy or sell with a few taps on your phone these days, real estate, it's not exactly liquid. You can't just cash out overnight if you need to.
That's a good point. Selling a house is a little more complicated than clicking sell on your brokerage app.
A little more complicated is putting it mildly. And then there's the diversification issue. Most of us, we can't exactly buy a bunch of properties in different cities to spread the risk, right?
Right.
You end up with, all your eggs in that one very expensive basket.
So no matter where you turn, it seems like there's no magic bullet, no guaranteed inflation-proof investment. It's all a bit of a crapshoot.
That's the thing. It really is. And that's why Graham keeps coming back to this idea of managing risk. Keeping your eyes on the long game, not getting distracted by the shiny objects.
So how do we actually do that, though? Especially when everyone's screaming about market crashes and runaway inflation.
Well, first things first, and I know it sounds cliche, but don't panic. Easier said than done, I know, but remember, inflation is a normal part of the economic cycle. It's not the first time it's happened, and it won't be the last. We've weathered these storms before.
It's reassuring to hear that, honestly. It's easy to get caught up in the doom and gloom,
Absolutely. It's like a roller coaster sometimes. But while it's important to understand how inflation can impact your investments, don't let it push you into making rash decisions. You don't need to throw your entire investing strategy out the window.
So no need to hit the panic button, sell everything, and hide under the covers.
Exactly. And that's where our old friend diversification comes in again. Having a mix of stocks, bonds, and hey, maybe even a small sliver of those alternative assets, if you're comfortable with the risk, can help soften the blow when inflation rears its ugly head.
Spreading the risk, not putting all your eggs in one basket.
Yeah,
Got it. Sounds like a pretty solid strategy, even if it's not exactly glamorous.
precisely. And remember, investing, it's a marathon, not a sprint. Don't get too caught up in every little market swing or make impulsive moves based on fear and headlines.
You're saying we need to chill out a bit.
A little bit. It's easy to get caught up in the moment, especially with how fast information travels these days. But taking a deep breath, remembering your long-term goals, that's what's going to see you through.
Easier said than done, though, right? To just chill out when the market's doing its whole roller coaster thing, especially with inflation, looming over everything.
You're telling me. It's not easy, that's for sure. And that's why, having that plan, that investing roadmap, and checking in on it regularly, it's crucial, making sure it still aligns with, what you're aiming for, how much risk you can stomach, even as things change around us.
So less about outsmarting the market and more about, outlasting it, having the discipline to stick with the plan.
Yeah, you got it. Graham, he was all about the long game. Don't get swept up in every little blip on the radar, those flashy headlines, the flavor of the month investments. Focus on the fundamentals. That's what matters.
And that's where having, a good financial advisor, someone you trust, that can be so helpful,
Wow.
right? They're there to remind you of the big picture when you're tempted to, I don't know, sell everything and run for the hills.
Totally. A good advisor is like part financial therapist, part guide. They get you your situation, your goals, how much risk you can handle, and they give you advice that's tailored for you, not just some generic spiel.
It's like having that steady hand on the wheel, helping you navigate all those twists and turns. So as we wrap up this deep dive into, Graham's wisdom, what's the one big thing you hope our listeners take away from all this?
I think the biggest thing is, and this is key, inflation is a real concern, no doubt, but it's not insurmountable. We got this. By understanding how it works, making smart choices, keeping our eyes on the prize, so to speak, we can weather the storm, come out stronger.
Knowledge is power, right? The more we understand about how this stuff works, the better equipped we are to make good decisions for our financial future, for ourselves, for our families.
Couldn't have said it better myself. It's about being proactive, not reactive, being in the driver's seat.
Well said. And on that note, I think we've covered a lot of ground today. Really appreciate you taking the time to break all this down with us.
My pleasure. Always a good time. Until next time.
Happy investing, everyone.